Bring that ass back like a boom, 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 boom.
Hey team, welcome to another free video on Boom Traders. Today we're going to talk about the Volatility Contraction Pattern, or the VCP. Now this was requested content by one of our members and I would love to go through it with you because it's super important and it's kind of one of the main things that we use when we pick stocks and when we decide when to enter and when to exit. Now, just as a session overview, we're going to go through the basic definition, we're going to show you some examples, and this will be kind of a really good about 60 to 70% out of the information that you would want to know. From there on, we have two more sections, which are advanced concepts and advanced examples, and they'll be later on in the video. Now, let's start off. Basically, the VCP is a tool that we use in order to time a low risk entry, and timing is everything in trading. Everyone looks pretty much at the same universe of few hundred names of stocks, and therefore deciding when to jump and when not is important, and this is what we refer to as timing. The reason why this is important is basically your goal as a trader ought to be, apart from protecting your capital, you ought to be to make money as quickly as possible, and you want to know when a stock is misbehaving, and that way you can use volatility contraction as a way to know what to expect from a stock, and when it does something, you know when things are wrong. Now, the inventor of the VCP is Minervini, but because I follow also John Carter in terms of his methodology, I would say the pattern does resemble JC's squeeze pattern, and both of them are looking for some sort of a contraction in volatility, as the name says. It is important here that both methodology look for that below normal volatility. Now, as you can see on the screen here, I've indicated a diagram. This diagram has been shared by Mark publicly, but I'm showing you my twist of it. Now, 1T or T means time frames, or 2Ts means 2 time frames, and so on and so on and so on. Basically, when you get 1T, you get a stock moving in this kind of a sideways action, and this is constructive. It's kind of what we refer to as flat base or consolidation pattern. There's no constructive action within the stock. It usually requires it to stay there for about 6 to 8 weeks and in a 10% kind of tight range. Now, 2T, 3T, 4T, and so on, these indicate larger drawdowns and successively smaller consolidation action. So let's say a stock has moved down 20%, then it reverts up, then moves down, but this time it doesn't go all the way to 20, but goes down to 15. Now, this is pretty much kind of the definition action for the VCP pattern. You need to understand that these are pretty much the effects and not the cause of supply and demand laws, and these are very much a consolidation patterns. And I'm just going to go over some examples to show you what these look like on the chart. Now, the first most important thing is we have to be in stage 2 in order to look for volatility contraction or for VCP. To know what stage 2 is, you can go in and check out our Discord video. We did a February monthly class for our members, how to identify the stages. But the most important thing is that we want to find stocks that are A, moving up, and B, have long-term characteristics of institutional support. This institutional support is seen by stage 2 characteristics. Institutional volume, in order to show that we have support from the large players, and this is when VCPs work the best. Now, as you can see here, we're getting very much kind of a cup and handle type of pattern indicated by the white line, whereby we had a contraction of about 13% on declining volume. We got our edge up signal. From then on, we had successive small contraction here of about 9% before the stock goes up and makes this big move that follows up. The main point is that we want to continue to correct, and we want to see those corrections becoming less, and less. So that's kind of what VCPs look for, and this is what we want to see. Now, as I said, we need to be in stage 2 criteria. I'm showing this again. Basically, we want stock price to be over the 115 200-day moving average. We want those stacked on top of each other, and we want the 200-day moving average pointing up while the stock is making higher highs and higher lows. Cannot stress how important this is for the methodology and why we always require stage 2. Basically, if you have stage 1, 3, or 4, you're either losing time or losing money. So that's why you want to avoid them, and we only upon confirmed stage 2 uptrend, we want to jump in on a stock. Now, as you see here, another example from Cent on a daily time. The point is that we have this correction down of about 13%. From then on, we have another correction at 7, then 4, then 1% before the stock goes up and kind of makes this really nice move up. So the key point here is that we wait for these contraction patterns or for these smaller and smaller contractions to start reaching single digits, because 2-digit contractions are way too volatile, way too wide, and this is not constructive. Peak to low is a single digit, and this is our second rule. So first rule is stage 2, second rule is single digit contraction. The tighter the point and the drier the volume, the better the buy point is. Now, I'm going to show you theoretically what this looks like and explain to you the logic and the psychology behind it, and hopefully this will be quite useful as well. Now, imagine you're buying at point A after a stock makes this really nice move up and you buy at point A. You might be a trap buyer, and if you buy here, you might suddenly see a drop very fast, let's say about 20%. This would be a very uncomfortable position for any retail buyer to find themselves in. Some point within the move down at point B, we might find some bottom fishers, and these are usually a very small group who buy the lowest low of the stock. Now, as the stock starts to move up, we come at point C, and this is where the two supplies at point A and point B appear. Basically, the trap buyers at point A see the stock coming back to their break even, and especially if the stock comes to pull back, like it might do here, they'll get afraid that it might do similar move down and hence sell their stock either at break even or at small loss, actually pushing the price down. At the same time, the bottom fishers who actually guess the lowest low would be having sizable profits up, and they'll be looking to cash some of that in because they again are seeing the stock moving down, again creating supply. This is usually, for a cup and handle pattern, what forms the handle, and sometimes you might get these little shakeouts here and here that would remove the weak hands from the market. Now, if you're wondering what a weak hand is, the weak hand is someone who's likely to sell too soon and is there for the short term. They're not going to hold through any major pullbacks, and these are the sellers who are easily shaken out of the stocks. You as a swing retail trader are considered weak hands as well, but the goal is to be the weakest hand. You want to be this last weak hand. You want to identify when there's the highest probability of the stock moving up, while knowing that if it violates some technical criteria, it's likely going to go further down. Now, back to the chart. As you see, at this point on the right is where the process starts to tighten up, and this happens on all time frames. This could be daily, this could be weekly, this could be 5-minute chart, 30-minute, doesn't really matter. These are the lows of supply and demand, and the tighter we get, the better, because supply is being sucked up at these points. Now, who sucks up the supply? Well, remember that we were in stage 2 uptrend and the stock was moving higher and higher and showing indication of institutional support. Well, this long-term accumulation patterns from institutions are showing that they're present in the stocks, and they're the ones who are buying up all this supply. They will support the stock when it's correcting lower, and they're taking these big positions, which sometimes could take months, if not years, in order to actually get started. Now, the key is to find stocks that consolidate and where supply has stopped coming into the market. The price will get tighter and tighter, and the volume will get way down, as you can see down here. So get really, really, really tight. And if there is supply, there will be trading. No supply means no trading, and no trading means no price movement and no volume. This is shown here. So when there's no more supply, the stock is becoming really tight. We might get some inside days, we'll get really low volume, and it will kind of stay there. Now, if you are correct in your assumption, this means that when there is no supply and a lot of demand, prices will go up. And remember, demand comes from the institution. This creates what we call the line of least resistance, or sometimes referred to as a pivot point. And this is where a small amount of buying, even a small amount, can cause massive shifts in the price. And these are the times when the stock gets kind of really explosive from there. Now, this is kind of the free stuff that we want to share with you guys. Hope you enjoyed it. If you do, join our Discord. We'll be continuing on with advanced concepts and advanced examples around VCPs and how to use them in your daily trading. We'll be reviewing VCP footprints, and we'll be looking at more examples and kind of a few more rules that will really bring an edge into your trading. But thanks for watching, and join our Discord if you want to see the continuation of this video.